Hi everyone, and welcome to this short video of SECO. I am Marco Parisi, head of SECO IR, and in this video, I will briefly walk you through the performance of our Q1 2022 results. So the first quarter of this year has been very challenging, given a market scenario where for almost everyone, it's extremely hard to find components. We see a lot of growth opportunities ahead of us, so we said, what are the best actions we can take to ensure the continuity in deliveries and get the most out of these opportunities? Now, we will see a few of them in a moment, but for now, let's just keep in mind that we posted almost 43 million euro of revenue versus 19 of Q1 last year. Our EBITDA is at 20%, and our GPM has held up at 47%, in line with the result of last year, thanks to a strong organic growth on the edge computing business and an ever-increasing performance on the SaaS one. What do I mean when I talk about visibility and growth opportunities? So first and foremost, I'm talking about a backlog which more than doubled on a like-for-like basis compared to the same period of last year. As of April 2022, backlog was at 164 million euro, which is a strong basis to back up our 200 million euro guidance for the full year 2022, which is confirmed. So, of course, this period is very challenging for us, like for any other industrial company in the world. We made a number of strategic choices with the goal to ensure the continuity in the shipping to our customers, because we think this is the best way to reinforce our relationship with existing customers, our reputation and long-term competitive advantage, and even to acquire new business opportunities, thanks to the fact that we have in-house production and the components available. Let me stress this aspect because it's very important. This scenario is a unique opportunity to get new business. And in fact, in the last quarter, we started over 5 design wins with new customers that were previously going at some of our competitors. These customers were nervous because they could not receive their goods on time, and they came to us because we were able to actually ship the goods. What does this mean in terms of numbers? We will see more in detail later on, but on the one hand, in terms of revenue, we have been able to match the strong growth of the order backlog. On the other hand, the overdue backlog is still around 4 million euro of deliveries that shifted from Q1 to Q2. And of course, the market price of components did have an impact on the GPM of our edge computing business. Of course, this also meant that we had to significantly increase our inventory to make sure we can ship as many orders as possible and minimize our overdue. We think this move is the best way to invest our cash flow in this kind of scenario. And before we move to the next slide, let me say, let us not make the mistake to assume that these GPM and inventory levels are normal for our business model, because they have been strongly impacted by what is the hardest quarter of the year in terms of market scenario. So let us now see the highlights of our Q1 performance. So in Q1, we posted 42.8 million euro of net sales, with a total growth of 120%, and in particular, 56% on an organic basis and 45% on a like-for-like basis. I mean, considering also the 12-month pro forma figures of the companies we acquired in 2021. Here, let me stress the fact that the edge computing business grew by 106%, while the SaaS continues to grow quarter by quarter at a very strong pace and is now at 9% of the Q1 total net sales. Regarding GPM, it more than doubled in size thanks to the expansion of the revenue we have just mentioned, while on a percentage basis, of course, the results has been strongly affected by the component shortage, and still, we are at 47%, which is in line with the 2021 full year result. Also, price increase actions and the ever-increasing contribution of Clea have helped the margins hold up, proving that the business model is resilient. Going all the way to the bottom line, adjusted EBITDA almost doubled in size, from 4.6 million to 8.6 million euro in the first quarter. Again, this is an increase related to the fact that both the edge computing and the SaaS business have further accelerated in the last quarter. The margin is at 20% of revenue in Q1, and if we compare it to the first quarter of last year, the difference in terms of incidence is fully explained by the gross margin effect we saw. And then a couple of words on the adjusted net income, which grew by 31% in Q1 2022 versus 2021. Here in the first quarter, we have higher D&A because, among others, we started to amortize the Guards and Free customers list as a result of the PPA. Higher financial expenses, largely due to the GNF acquisition financing, and taxes calculated with a theoretical tax rate, which could lead to an upside once the actual taxes are calculated at the end of the year. Finally, from a net debt perspective, Of course, this number has been impacted by a strong increase in working capital for around 12 million euro to ensure as much as possible the availability of components in such a tough market scenario, and for around 4 million for additional trade receivables as a result of a strong expansion of the business. On top of this, let's keep in mind that there is a further effect on the net debt increase given by some Garz & Fricke M&A transaction costs around 7.5 million euro and the purchase of treasury shares for around 5.7 million euro. So what do we see in front of us for the next quarters? First of all, a very high visibility on our order backlog, which is at over 160 million euro and more than double versus last year on a like-for-like basis. For this reason, we have confirmed our full year guidance at 200 million euro, and we see a very strong acceleration coming in the second quarter with around 52 million euro of net sales, implying an almost 70% organic growth and a like-for-like growth above 50%. Not only the edge computing, but also the SaaS business is accelerated. Of our pipeline of 500,000 devices, around half of them is under contractualization. And just in the last month, we started over 10 new projects on Clea, of which 6 in the United States. And finally, at the end of April, we announced a very important deal with Camozzi Digital, thanks to which we strongly boost our offering in the industrial IoT, with over 90 ready-to-use apps, connectors, and algorithms that will end up into 2 new versions of Clea dedicated to the industrial world. This is a deal from which we expect over 50 million euro of cumulated incremental revenue in 2023-2025. So this is a very short overview of how our Q1 unfolded. Thank you very much for watching. I am available for any additional information, and I am looking forward to get in touch soon.
Since you watched this company video until the end, I'm guessing you liked the video. That's probably because we work very hard to create the most engaging and value-added content possible for you. If you're a stock-listed company or corporation and want to find out how we at C11A can make a company video with and about you, please email us at community@c11a.com.